I think if you're working with a small amount of money, I think you can make very significant sums.
Have you ever wondered how the world's most successful investors started their journey? Believe it or not, it began with just a few dollars. Today, we're looking into the mind of Warren Buffett to uncover the secrets of investing small amounts of money. We're not just talking about any investment strategy. We're revealing how Buffett transformed modest sums into a vast fortune. So, if you've ever thought your savings were too small to make a difference, this video will change your perspective and show you the path to financial growth. Get ready to learn, straight from the wisdom of the Oracle of Omaha. You'll learn how to turn the smallest investments into significant wealth. In his early days, Buffett didn't have millions at his disposal. Instead, he worked with a modest amount of capital. Yet, he managed to achieve extraordinary returns that laid the foundation for his future success. How did he do it? The key was his unique approach to investing, which involved focusing on undervalued opportunities that many investors overlooked. Buffett's strategy during these formative years was simple but deep. He searched the market for stocks that were not just cheap, but significantly undervalued compared to their intrinsic value. This meant looking into companies that were often ignored by a majority of investors, either because they were too small, deemed too boring, or facing temporary issues that scared off the average investor.
We look at it as the criteria for selecting a stock is really the criteria for looking at a business.
In this clip, Buffett talks about his methodology for selecting stocks. He wasn't just looking for low prices, he was searching for quality businesses trading at prices far below their worth.
We are looking for a business we can understand. That means they sell a product that we think we understand, and we understand the nature of their competition, what could go wrong with it over time. And then when we find that business, we try to figure out whether the economics of it means the earning power over the next 5 or 10 or 15 years is likely to be good and getting better.
This approach required deep research and analysis, combing through financial statements and market reports, and understanding the business models of these companies. Buffett's early investments were not in the big names that everyone was talking about. Instead, he found hidden gems in the market. Small, unglamorous businesses that were solid in terms of their financials and business models, but were undervalued by the market. He often spoke about cigar butt investing during this period, a term borrowed from his mentor, Benjamin Graham.
We want to be in good businesses. What we really want to be is in businesses that are going to be good businesses and better businesses 10 years from now. And we want to buy them at a reasonable price. But many years ago, we gave up what I've labeled the cigar butt approach to investing, which is where you try and find a really kind of pathetic company, but it sells so cheap that you think there's one good free puff left in it.
This analogy referred to finding a cigar butt with one puff left in it, bought for less than the value of that puff. In investment terms, it meant buying a stock cheap enough to ensure a profit even if the business didn't perform well. This phase of Buffett's career is crucial for small investors to understand. It demonstrates that you don't need vast sums of money to start investing successfully. What you need is the ability to identify undervalued companies and the patience to wait for the market to recognize their true value. This approach can be particularly effective for small investors who, unlike large institutional investors, can invest in smaller companies without worrying about the impact of their investment size on the market. Now let's look at what we learned about the world from Warren Buffett's videos. Principle number 1 is look for undervalued opportunities. Buffett's first principle is to seek out companies that the market has undervalued. These opportunities often lie in smaller, lesser-known companies that have not yet caught the attention of large institutional investors. The key here is to find businesses that are trading for less than their intrinsic value. Identifying these undervalued stocks requires a keen eye for value and an understanding of what makes the business fundamentally strong, yet currently underappreciated by the market. Principle number 2 is do your homework. Buffett emphasizes the importance of thorough research. This involves a deep study of the company's business model, financial statements, management quality, and competitive positioning in the industry. Understanding the business means getting to grips with how the company makes money, its growth prospects, the sustainability of its competitive advantage, and the risks it faces. Analyzing its financials involves looking at its revenue, profit margins, debt levels, and return on equity, among other metrics. Buffett's approach is not just about picking stocks, it's investing in businesses. This level of understanding ensures that investment decisions are based on solid fundamentals rather than market speculation or trends. Principle number 3, be bold but not reckless. Buffett advises that when a great investment opportunity is identified, one should not hesitate to allocate a significant portion of their portfolio to it. This principle of concentrated investing goes against the conventional wisdom of diversification. Buffett believes that diversification can dilute returns if it means investing in mediocre businesses. However, he also cautions against recklessness. Being bold in investing means having the conviction to back your research and analysis with substantial capital, but it also means being acutely aware of the risks involved. You need to find a balance between being sure of your investment choices and being careful in case the market changes in a way you did not expect. This approach requires discipline, patience, and a long-term perspective, qualities that have been hallmarks of Buffett's investment strategy throughout his career. For individual investors, applying these principles can be a powerful way to grow small investments into significant wealth over time. Calculating the potential growth of an investment is a crucial aspect of understanding how small investments can lead to significant returns, a concept that Warren Buffett has masterfully utilized throughout his career. Let's consider a scenario where you start with an investment of $10,000 in a stock that, after thorough research, you believe is significantly undervalued. Suppose this stock grows at an annual rate of 20%, which is not uncommon for a successful small investment that has been carefully selected based on its fundamentals and growth potential. Over a period of 10 years, the power of compound growth comes into play. Compound growth, often referred to as the eighth wonder of the world, means that you earn interest not only on your initial investment, but also on the interest that accumulates over time. In this example, if your $10,000 investment grows at 20% per year, it would more than sextuple, growing to over $61,000 in a decade. This remarkable growth is attributable to the compound interest effect, where each year's gains are reinvested to generate their own gains in subsequent years. This kind of compound growth is precisely what Buffett capitalized on in his early years of investing. He understood that even small amounts, when invested wisely in undervalued, high-potential stocks, could grow exponentially over time. This principle remains as relevant today as it was in Buffett's early days. It highlights the fact that successful investing is not necessarily about starting with a large sum of money, but rather about making smart investment choices and allowing time to work its magic. Whether you're starting with $1,000, $10,000, or any other amount, the fundamental principles of investing wisely remain the same. It's not the size of your initial investment that matters most, but how effectively you invested. Let's look at some real-life examples from Buffett's life where he has applied these principles. Warren Buffett's investment in Geico is a reflection of his unique approach to investing and his ability to recognize potential in its nascent stages. His journey with Geico began in his early 20s, a period when he was a student under the tutelage of Benjamin Graham at Columbia University. Buffett's interest in Geico was piqued when he learned that his mentor, Graham, held a significant stake in the company. Driven by curiosity and the desire to understand the business better, Buffett decided to take a trip to Washington, D.C., seeking to learn more about Geico directly from its source. Upon his arrival at Geico's headquarters on a Saturday, Buffett found the offices closed. However, fortune favored his bold initiative, and he met Lorimer Davidson, the vice president of Geico, who was working that day. Davidson generously spent hours with Buffett, explaining the nuts and bolts of the insurance business and, more specifically, Geico's unique business model. Unlike traditional insurance companies that sold policies through agents, Geico sold directly to customers. This direct selling approach allowed Geico to offer lower premiums, a competitive edge that Buffett immediately recognized as a turning point in the insurance industry. Impressed by Geico's innovative business model and its potential for growth and profitability, Buffett made a decision that was both bold and unconventional. He invested more than half of his net worth into Geico's stock, a move that demonstrated not just his confidence in the company's future, but also his willingness to back his convictions with significant capital. This investment decision was rooted in a deep understanding of Geico's value position and its potential to disrupt the traditional insurance market. Over the months and years that followed, Buffett's investment in Geico proved to be extraordinarily fruitful. Geico grew exponentially, becoming one of the largest auto insurers in the United States. The company's growth trajectory and increasing market share turned Buffett's initial investment into a massive fortune. This investment in Geico stands out as one of the most successful in Buffett's career, showcasing his ability to identify and capitalize on long-term value. It also exemplifies his investment philosophy, which combines thorough research, a focus on business fundamentals, and the courage to make substantial investments in companies with strong growth potential. Warren Buffett's investment in American Express during its crisis in the early 1960s is a classic example of his contrarian investment approach and his ability to spot opportunity in the midst of adversity. The crisis, known as the Salad Oil Scandal, was a significant moment in American corporate history. American Express, then a burgeoning financial services company, found itself embroiled in a major financial fraud. Its subsidiary, American Express Warehousing, had been duped into providing loans against tanks of salad oil, which were later discovered to be filled mostly with water. This scandal not only led to massive financial loss for the company, but also caused its stock price to plummet, as investors lost confidence and the market reacted to uncertainty. However, where most investors saw disaster, Buffett saw the opportunity. Rather than following the herd, he took on his own thorough analysis of the situation. Buffett's approach was hands-on and grounded in real-world observation. He visited numerous restaurants to gauge how widely American Express cards were accepted and engaged in conversations with users of American Express services. Through these interactions, Buffett sought to understand the true impact of the scandal on the company's core business operations. His analysis led him to a crucial insight. The salad oil scandal, while serious, had not fundamentally undermined the intrinsic value of American Express's core credit card and travel services business. Buffett recognized that the company's brand and market position remained strong, and the scandal was more of a temporary setback than a permanent impairment. Acting on this conviction, Buffett made a bold investment decision. He allocated about 40% of his partnership's assets to purchase American Express stock, a move that was both daring and unconventional given the prevailing market sentiment. This decision was a clear example of Buffett's investment philosophy, which emphasizes understanding a company's fundamental value and being willing to act decisively when the opportunity presents itself. The subsequent turnaround of American Express vindicated Buffett's decision. The company managed to navigate through the crisis, restore its reputation, and its stock price rebounded. This investment not only yielded substantial returns for Buffett and his partners, but also solidified his reputation as a savvy and smart investor. It underscored his ability to cut through market noise and panic, focus on long-term value, and make investments that others were too afraid to consider. In conclusion, the journey of investing small amounts, as guided by Warren Buffett's principles, is filled with potential and opportunity. It's not the size of your investment that matters, but the strategy and wisdom behind it. We've uncovered the power of thorough research, the courage to seize undervalued opportunities, and the magic of compound interest. Now, we'd love to hear from you. What are your experiences with small investments? Have you discovered any hidden gems on the market? Share your stories and insights in the comments below. Let's continue the conversation and inspire each other to make smart, informed investment choices, no matter the size of our portfolio.